Good morning, ladies and gentlemen, and welcome to the Quiz PLC final results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and your participation, I'm sure, will be greatly valued by the company. And I'd now like to hand over to Shiraz Razman, Chief Commercial Officer from Quiz PLC. Good morning, sir.
Good morning. Thank you, Mark. Good morning, everyone. Thank you for joining us. Just to present the results of the year ending March 22 for financial performance. So my name is Shiraz Ramzan, Chief Commercial Officer at Quiz. I'm sitting with Jerry Sweeney, our Chief Financial Officer. So just to run you through our results, we're pleased to report a very positive year. As you know, the pandemic period was very tough for the business, and we took quite definite steps during that period to manage the environment, to manage cash flow, etc., and protect the business. As we saw demand for some of the categories that we specialise in weaken. However, since February onwards and since restrictions have moved away, we've seen a real resurgence in demand. We've seen the traffic across all areas of the business, including stores and online, come back very strongly. And we're pleased to have seen a very strong performance in terms of revenue growth, up 97%. And we've achieved a 60% margin, which is well up from the previous year. We're happy that we've achieved a positive EBITDA of 5.1 million, improving 10 million from the previous year, and profitability before tax of 0.8 million. Operating cash flows of 5.3 million a year, 7.8 million higher than the previous year. So as you can see, it's been a very positive year for us, and we're happy to be getting back to normal trading. We've seen demand for our core categories return, and we've seen like-for-likes in stores and online return back to 2019 levels. Just to sort of run you through a few operational highlights, some additional highlights. As you can see, active customers are up 74% on the prior year. The store estate, we did reduce some stores down to about 62 in the UK and 5 in the Republic of Ireland. And we'll talk a bit later about our plan to grow the estate as we look to move the business forward. I'll just pass you over to Jerry.
Morning. I'll just take you through some of the numbers now in terms of a little bit more detail. In terms of, as Shiraz touched upon, we're very pleased with the return to profitability and positive cash flows in the last 12 months, which is even with revenues running below the normalised rate. So it's we've been happy with the overall outcome for the year. I'll come on and talk about the makeup and the growth in the revenues and the constituent parts of the costs later on. I think just in terms of this slide, the one factor that's not mentioned later on is the income tax credit. So we've got a £1.3 million benefit coming through in our profit and loss account to do with a tax. Now that is tax losses that were incurred in previous years. And because of the kind of uncertainty as to the level of profitability going forward, the benefit of that had not previously been recognised. But now that we've got the confidence with regards to ongoing profitability, we've obviously agreed with our auditors that we will get that benefit, and that'll be a £1.3 million reduction in our future corporation tax bills. That's what that represents. So that obviously enhanced the 800,000 of pre-tax profit actually turned into 2.1 million post-tax profit for us because of that. So just to explain that factor there, and just to I suppose comment on the fact that we've got the confidence going forward now to recognise that in the accounts. So with regards to revenues, you'll see obviously there's some quite significant changes there. The largest to do with stores and concessions in the UK. Obviously, the primary factor there would have been the extent of lockdowns in the previous financial year. The stores and concessions were effectively closed for 6 months. So obviously the year gone by, it's just been short of a month. So that is the primary factor driving the growth in revenues. But as Siraj touched upon, it is worth commenting that what we saw after stores opened in late April last year was a progressive improvement in the performance of the stores relative to the pre-pandemic revenues that were generated. And that steadily improved through the year. And once all the restrictions were lifted in post-January, we saw a kind of return to like-for-likes comparable. We saw sales at a comparable level to pre-pandemic levels. And there's obviously a reference to the current trading later on, which we'll talk about in due course. The online business, bit of a mixed bag there. Our own website increased by 64% in the period. And in terms of that, so we saw strong growth there. But we did regress in terms of third-party sales, which dropped back 21% year on year. So that was partly to do with the fact that we used to trade with Debenhams online. So that was part of the reason, but also we have made a conscious decision to reduce the amount of stock that we make available to certain third parties. I think it's very easy to provide stock and it comes back 6 months later and creates a problem for you. So, and actually we found that by restricting the amount of stock that goes through and managing the overall gross margin, that these accounts can be more profitable. So that was a conscious decision on our part, as I say. Internationally, the different markets obviously returned to normality at different levels. So the lockdowns in Ireland lasted a bit longer than the UK. There's about half that revenue in Ireland, half of it internationally, largely in the Middle East and America. The international revenues are now similar to the UK, back to where they were pre-pandemic and running at that level. What has that meant for the rest of the business? Just under half the business is again generated from stores and concessions. What's changed from pre-pandemic is that is the vast majority of that is now generated in our own stores, as opposed to concessions where we generated a lower level of return and obviously had a degree of uncertainty as to the longevity of certain partners. So that's a positive there. Online, come back to a similar level as it was pre-pandemic, but similarly to the stores and concessions, there's a higher proportion of that driven through our own website now, where obviously we've got a better degree of control and a higher level of return traditionally. So that's the kind of reshaping of the business has kind of brought it back more into our own control and into the channels that have traditionally generated higher levels of return for us. With regards to costs, obviously a year-on-year comparison is to be blunt, is of limited use, given the shape of the business in terms of the level of lockdowns that happened last year. Employment costs have stayed roughly the same. There's been a lot more activity in the distribution centre, obviously with online sales going up, but that's been compensated for by a reduction in headcount in stores and the head office. Those were decisions taken in the previous year and the benefit of that flowing into the current year. The property costs is a right old mixed bag. We have seen our rental costs reduced by more than 50% compared to the pre-pandemic. Last year we did see part of the rates bill come back. We normally pay about £3 million in rates. The rates relief that was available to us meant that we only paid about £1 million last year. That will come back to a normalised level this year. So that's a bit of a mixed bag as well. Marketing, Shiraz will come on and talk about. Distribution costs are made up of two things in the business. They're made up of the commission that we pay to third parties, and that £2.5 million increase almost exclusively relates to an increase in commission with an increase in sales. We've actually not incurred any increase in our delivery costs. From an accounting perspective, offset the delivery income we get from our online customers against the cost to deliver to them, and that has balanced out in the current year, so we've not actually incurred more costs there. The reason for that is during the pandemic there was quite an extensive use of free delivery as a promotional tool to help drive costs there, so that's reverted back to normality in the current year. We did make some use of the government support, £1 million, largely furlough money that came in April and May of last year, just as things returned to normal, but that was the extent of that. Just in terms as the balance sheet, just the comments here would be, preservation and of cash, and subsequently the rebuilding of cash has obviously been a priority within the business. So capital expenditure has been limited. It was only £500,000 last year, so that led to the reduction in the overall fixed asset number. But what we've planned for the current year is probably we'll see an increase in that, maybe up to £2 million in the current year, as we flick the trigger on some IT projects that have been deferred through the pandemic, do some work at the DC in terms of improving its configuration and efficiency, and as well as potentially opening a small number of stores in the current year. With regards to working capital, increase in receivables and payables, just to reflect increased activity. The inventory has gone up in the year, obviously as we've returned back to normal and need more stock for it. One comment in passing would be we've actually reduced the provision that we hold against slow moving stock by more than £1 million in the current year. So we did a good job at the beginning of the year clearing out stock that had built up during the pandemic. The first 6-8 weeks of activity was focused on clearing that out, and then it reverted back to full price sales. So that's the benefit of all that is reflected into the cash flow, which is just the last slide I'll present to you for the moment. Just in terms of that, operating cash reflects obviously the improvement in performance, generating more than £5 million for the business, which led to that £3 million increase, just short of £3 million increase in the cash available to the business. The last point on this would just be to confirm that our bank facilities have been renewed. They were renewed just prior to the audit being signed off on the 30th of June. So that £3.5 million facility is available to us again for the next 12 months. So just as so the working capital and the liquidity of the business is where it was before, just steadily improving with the cash position. So I'll hand back to Shiraz to take you through some other comments.
Thank you. So just over on page 13. So as we sort of highlighted, since restrictions were lifted, we've seen a real increase in demand for Quiz and our product offering across both online and our store estate as well. So our sort of key offering, as you know, is occasion and dressy going out wear. So we've seen a real resurgence of demand for those categories. We also offer quite a strong range of what we call dressy casual wear, for example, holiday wear or things that women like to dress up and wear out during the day. So all categories have been performing very strongly. Online, as we mentioned earlier, we've seen about a 24% uplift in overall online sales, and within that, the Quiz site has achieved a 66% uplift, which we're very pleased with. Active customers have increased 74% to 563,000. So again, a real strong increase in active customers coming to shop for our key categories. As we sort of mentioned, in regards to third parties, we have scaled back a little bit from third parties, and we're putting more emphasis on our own direct-to-consumer channels. We are doing very well with the Very Group, and we are performing strongly with Next. So those would be two of our key partners that we're continuing to trade with. However, as I mentioned, there's quite a lot of focus on our own channels, and there's a few initiatives and a few different projects underway within the business to further enhance that, include to include scaling up our omni-channel offering. So there's some new IT resource and investment happening, which will allow us to achieve some initiatives like single view of stock and single view of customer, online order fulfillment through stores, click and collect fulfillment through store stock, etc. Which these are some of the initiatives that will be live for next year. So we believe that these initiatives will enhance the offering further and improve the customer experience further. In terms of UK stores and concessions, as Jerry mentioned, we've seen like-for-like sales bounce back to pre-pandemic levels. We have around 62 stores in the UK, and in total, the store count, we have about 69 if you include Irish stores. If you look at the count versus 2019, we've obviously dropped significantly. That would be predominantly down to the disappearance of Debenhams from the high street and other partners we had, including the Arcadia Group. However, with that scaled down store portfolio, concession portfolio, we feel we have a more profitable and flexible base to operate from. As we mentioned, we've restructured the store estate. We've achieved turnover leases across the majority of stores. Some of those arrangements are up for renewal, and we are renewing at fixed rentals in some stores now, as the landlords have become a bit more bullish. However, we're very comfortable with those deals. We've got sort of 5 years deals, 3-year breaks, so we have flexibility in there, and we're confident that the rentals that we are tying up are ones which allow us to trade profitably from the stores, because we also have the historical turnover performance, and we've seen the bounce back in demand to 2019 levels. So just on the page, we talked about gross margin. So we did have a tail of product to clear through during the pandemic period and at the end of the pandemic period. So we have been quite successful in clearing through that. We've actually seen a real sort of, just to echo the comment about the resurgence in demand, the real demand has been on full price new product, and we've been bringing lots of that in, selling through without having to do much discounting on new product. That's helped drive the gross margin up to over 60%. There is, as you know, right across the industry, there's an increased pressure on costs, and we have had to revise pricing in certain categories. There's maybe been an increase of approximately 10% on average across our product categories. However, as you know, we're not looking to offer the lowest prices in the industry. We're looking to offer good value, good quality. So we have been speccing up some of the garments, and we believe that we're still offering good value despite some of the price revisions, and we're not seeing any resistance to that from the customer. So that seems to be going well. Even in current trading, it seems to be continuing to go well. Just over the page. As you mentioned, we did do that restructure during the pandemic period. I'm sort of repeating some of the points I made earlier, that we did scale down and move to a more flexible business model. We do believe that we have a good, strong infrastructure and a flexible infrastructure to support future growth. We're pleased to announce that the operating costs have increased 22%. However, revenues increased 97% over the period, so we're quite happy with that ratio, and we're looking for that to continue. Just on some of the cost pressures, I mentioned some of the pressure on margins. That's come down to a few factors, including increased freight, energy costs, for example. Obviously, we have going forward wage inflation and a reduction in business rates relief. So as I mentioned, we've managed to react to that through some pricing revisions across some of our core categories. And I think we've managed to successfully handle some of these challenges. We've not really seen any measurable or any significant impact, I should say, on margin. In fact, we've seen margin improving, and we're quite confident that we should be able to maintain that going forward. Just in terms of marketing, so if I just sort of talk generally about the environment and from a competitor sort of perspective, there's been a lot of change in the industry. As you know, as I mentioned, some of the brands like Debenhams and Arcadia are no longer trading offline. There's quite a number of other brands that are no longer offline. Some have disappeared from the industry, some have gone online only. And we believe that's sort of created a new competitor landscape. It is a new retail landscape, and we're seeing a lot of opportunity as we move the brand forward. So coming out of that period of restrictions, we've really sort of looked to get back on the front foot in terms of marketing to drive the brand forward and grow brand awareness and grow traffic. So as we've sort of demonstrated before, we do have a broad appeal in terms of age range with the brand. We've got sort of several generations of ladies shopping with us, from teenagers up to women sort of 50 plus shopping with us, or 60 plus, looking for dresses or outfits to wear at events or occasions during the day or during the night as well. So in terms of marketing, we sort of spent roughly 3% of revenue last year, and it was about 2.3 million in terms of marketing spend. So we're looking to increase that. We increased that to 3% last year, and a lot of that was to get back on the front foot in terms of advertising, and a lot of that has been through digital activities. So about 70% of the budget was spent on digital marketing, where we achieve a clear return on investment, and things like social media advertising, Google advertising, all that's been going well, and we've actually seen quite a strong ROI continue there. So as we've seen demand come back, the ROIs and marketing spend have improved, and we're looking to scale that up as we go forward. Some of you may recall some of the celebrity activations that we engaged in over previous years. So again, we're looking to scale that up, and we've got some more activities in the pipeline for this year. So again, just to sort of highlight, we're getting back in the front foot of marketing and really looking to take advantage of the opportunities in front of us. So just in terms of sort of current trading and where we are, as you mentioned, since February onwards, we've seen a marked increase in demand, and that's really continued through to sort of recent periods. There's been a lot of reports in the press and sort of widely acknowledged in the industry that there's been a sort of retail downturn, and down to inflation due to customers' pockets being squeezed, etc., from a number of different angles. But we believe that we've taken steps to really improve the offering. I think during the pandemic period, we didn't sort of sit still. We put a lot of focus on design, buying, and making sure that when demand came back, we'd improved our offering. I think we've done that, and that's reflecting in the current figures. So as we sort of move the brand forward, we feel that we're very well positioned to grow and to grow profitably and get back to the sort of the targets that we'd set previously. As we sort of demonstrated, we've seen that resurgence in not just online, but also in stores. I think we've seen in recent years a real sort of disruption in the retail industry from all the online brands and the sort of shift to online. I think some of you may have sort of seen from reports of other sort of more omni-channel brands that there seems to be a real return to stores and a return to demand for shopping in stores. So we feel that having an omni-channel business model is really the correct model, and we feel the more advantageous model going forward. Being able to couple stores with online, we feel is a more compelling proposition for the customer. And as I mentioned, we are investing in IT systems and enhancing our omni-channel offering. And we find that when we open stores, we see a bit of a halo effect of an increase in online demand in that region. So as we move the business forward, we're really looking to take advantage of opportunities in all channels. We will be opening new stores. We've opened a few recently, which are performing well. We are investing in the online channel, looking to really develop that area alongside growing the store estate and enhance the sort of customer experience through all channels. So just to sort of summarize, we're first of all, we're very pleased that we've come through the pandemic period, sort of protected the business, protected all our employees and stakeholders in the best way we could. We've come out strong. We've seen that the demand has come back very strong, and we feel very confident and excited about the business going forward. There's lots of opportunity for Quiz. As I mentioned, a lot of brands have disappeared from the high street, and that's opened up a lot of opportunity. With roughly about 69 stores across the UK and Ireland, there's still opportunity to grow more stores on the right cost base, on the right rental terms. We feel that we've got a well-developed business model. We're able to deal with challenges out there, and despite some of the negative reports that we're hearing in the industry, we don't seem to be experiencing that significantly ourselves. I think that's down to the business model, the differentiated proposition, the steps we've taken to enhance our design and product offering, and obviously the hard work that's gone into restructuring the business and making sure that we're well positioned and we have the right infrastructure to take the brand forward. So overall, just to sort of summarise on that point again, there's a lot of positivity in the business, a lot of excitement. Everyone in the business is motivated and happy with the recent performance, and we look forward to growing from here on forward. There are challenges on the horizon. We're not ignorant of that, but we're pleased that we're not really seeing the disruption that's being reported across industry, and I think that's down to all the steps that we've discussed. So we're excited about the future, and we're looking to grow the business as we move forward now.
That's great. Jerry, Shiraz, thank you very much indeed for your presentation and for updating investors this morning. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while Shiraz and Jerry take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Jerry, Shiraz, we did receive a couple of pre-submitted questions ahead of today's event, and as you can see, you've received a number of questions throughout today's presentations. So I wondered if I may just start off by reading out a couple of the pre-submitted questions for you. The first one reads as follows: What will be the triggers to enable the board to start recommending the payment of a dividend in the future?
Yeah, I think obviously there are two parameters there. Obviously, in terms of the strength of the balance sheet and profit generation, to be, I think the cash that Shiraz just referenced there, just at £8 million at the end of June, that's actually, we're now in a better position with regards to cash and liquidity than we were pre-pandemic. So there's been quite a rapid recovery in that, I'd have to say. In terms of that, that's been in excess of our expectations, so we're obviously quite happy with that. So I think it would be, I would struggle to say that the balance sheet wasn't strong enough to do it now. So obviously the second criteria is the level of profitability generated within the business. We're not getting carried away with the fact that we made £800,000 last year. We're obviously happy with it, but we want the business to be generating a higher level of profitability. I think, once we see that a higher level of profitability we think is sustainable, and then we'll start to declare dividends. But I think just to, the earliest that conversation we had in the boardroom, I would imagine would be next May, June, when we see the financial results for next year, and we'll obviously have a decision to make at that point. That would be the clear criteria for us.
Thank you very much indeed, Jerry. And if I may turn to the second pre-submitted question, which reads as follows: You've said that there was some benefit from business rate waivers, which I assume is within the cost of sales, in addition to the 1 million furlough stroke grant income you separately disclosed. But presumably there were costs of business disruption and lower sales offsetting these factors. Overall, do you see a net headwind or tailwind going into the full year 23, assuming no further COVID disruptions?
Yeah, I think all things being equal, revenue normalising will give us a larger benefit to us than the supplements to costs that came in during the pandemic. I think that £1 million of furlough, just to be clear about that would have been paid to store staff, largely to store staff who, when stores weren't open. So it was pretty much neutral, that money coming in. There was a £2 million benefit from the rates relief last year. But obviously we think that the uplift in sales and the benefit that would give us would be more than £2 million. But just to give you the accountant's caveat to that, as Shiraz touched upon, there are a number of other costs that are increasing the business. I think we're not immune to the wage inflation and pressure on wages that is happening right across the economy at the moment, as well as some of the rises in input costs that we're seeing. So I think a lot of that benefit from the increased revenue will be negated by increased costs in the next 12 months, unfortunately. But as I say, it's some of many moving parts at the moment.
That's great. Thank you, Jerry. Well, that takes care of the two pre-submitted questions. As you can see, Shiraz, Jerry, that there's been a number of questions submitted from investors throughout your presentation this morning. And thank you to everybody for your questions. If I may, could I just hand back to you to read out the questions and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Sure. So next question is, do you see Quiz expanding internationally? And if so, what's the strategy to execute on this? So yes, we are planning to expand internationally. Our sort of two key areas that we're focusing on is the Middle East and the USA. So the strategy really for international expansion, we've always taken the view internationally for low cost, low risk expansion. And we do that, we sort of manage that through wholesale or franchise arrangements. So the Middle East, we have a number of partners that we're trading very strongly with. Again, we've seen demand in those international territories really bounce back strongly. And in the Middle East, most of our partners operate on a franchise model. In the US, we're operating more on a wholesale model. So again, we sort of look to protect as much as possible any revenues or income through standby LCs or bank guarantees, etc. And that's really the model that we look to move forward with. In terms of the next question, do you use social media influencers to promote the brand? How do you track its success, and how does this compare to other traditional marketing channels? Yes, we do. We, as I sort of mentioned, in terms of marketing spend, about 70% of our spend is on digital marketing. So that would not include social media. Social media would fall, in terms of influencer spend, would fall within the 30%. So we have an ongoing program every week, every month of a sort of budget that we set towards influencer marketing. And we measure that in a number of ways. We look at reaction in terms of likes, engagement, comments, etc. We look at traffic that we generate from social activity to the website. We look at social media audience growth, etc. There's a number of different factors that we look at, but the real sort of ROI marketing is really on the digital side. That's where you really get a clear measure of how much you've gained for every pound spent. Some of the influencer marketing is more sort of brand awareness, etc., which again is important, but it's not maybe as easy to put an ROI figure on it, but it is an important part of the marketing mix. Next question, are you looking to develop products that are more ethical, sustainable? I note the like of Superdry and others are taking steps in this regard. Yes, we just actually launched last month our first capsule sustainable range. So it was a small range that was launched online only. It was made of predominantly recycled polyester fabrics, and it was a sort of well designed range in terms of making sure that the fabrics used were actually from a sustainable source. We made sure we had third-party certification, and that it was all as it should be in terms of not being accused of greenwashing and just producing fabrics which are not actually sustainable, as some brands have been accused. We did see a good reaction to that. It has performed well. We are repeating some of that product. We're bringing more of it in for the AW period and looking to expand in that range. I think if you sort of fast track forward a number of years, the view is that some of those fabrics will just become a normal, regular part of our range, and we'll really look to sort of increase that as time moves forward. In terms of sustainability in general, it's not just the product side of things, but in terms of the actual business operational side, we've made quite a number of steps in enhancing that by moving the business over to green renewable energy across head office, DC and stores, and which has significantly reduced our carbon output. We've switched all our plastic bag packaging to recycled and recyclable packaging. Those are just some of the initiatives we've done. There's quite a lot more in the pipeline that we have done, we are working on, so that's an important focus for the business going forward. Next question, what are the downsides of being omni? Well, I think if you sort of rewind slightly, I think, you know, as I mentioned, there was a point in time where online was all the focus, and that's really where all the growth is coming from, and a lot of store-based brands were finding things tough. But I think the environment's changed, and I think we've seen a resurgence to stores. There can be a downside to omni. There can be a downside to having too many stores or having stores on the wrong types of deals. So I think we've addressed that by the initiatives that we mentioned earlier in the presentation, how we've achieved a flexible infrastructure across stores and online, and I think overall there's more advantages to omni than downsides. Having touch points and being able to communicate with the customers offline and online is an advantage, and being able to offer refunds in store or online returns in store. I think you might have noticed Boohoo Group introducing a charge for online returns. Obviously they're online only, so that's not something we've done, and if we did do that, we've still got the advantage of being able to offer free returns in stores. So I think overall the benefits of omni outweigh being exposed to only one channel.
Next question is from Kevin, who asks how we intend to enhance the current share price, which despite the results is still obviously, in Kevin's view, an all-time low. You know, I think in terms of that, I think there's obviously been a volatility in the performance of the business, given the pandemic and given some of the challenges that were there before we restructured. So I think with the share price, you know, obviously the main thing we can do is now just be consistent, get profits back up and deliver that. I think in terms of being more active on that, you know, I think we've referenced the dividend, which hopefully would give some value back to shareholders in due course. Being more interventionist in terms of using our cash to buy back shares, etc., is not on the agenda at the moment. You know, I think there's plans to develop and grow the revenues of the business, and I think we can make a better use of the cash available to us at this point. But you know, I think obviously it's something we'll just have to keep under review and keep working at it. And say if we keep posting positive results, the share price doesn't move, then we might take a different view in due course. So.
Next question from Joe. Thanks for your presentation. What is the ROI per £1 spent on digital marketing? So we wouldn't accept anything under 6 in terms of ROI. So in terms of net ROI, we do achieve significantly higher than that in certain activities. So there's a number of different channels to digital marketing, including social media, advertising, obviously PPC, SEO, Google Shopping ads, etc. So some of those activities can generate as high as 10, but we wouldn't really target anything under 6.
The last question for the moment, unless if you've got a question, don't be shy. The last one for the moment is from Ralph, who has comments that we're much stronger in the north of the UK. Do we have plans to be more orientated towards the south? Yeah, no, certainly we do, you know, put the pins on the map. You know, we're obviously strong in Scotland, where we've been established. In the north of the UK, there's a number of gaps down south. So we are looking to increase the store portfolio. If we can get the right rental deals, then that for us is just to have a kind of balance of flexibility in terms of cost and term. So I think at the moment there's we are finding that we can still achieve those rental arrangements. So we are looking to extend the store portfolio, and yeah, the balance of that will be towards the south of England, where we are unrepresented. We have less representation.
That's great, Jerry. Shiraz, I think, as you said, you've taken every question from investors submitted today. So thank you for doing so. And thank you once again to all those on the call for their engagement this morning. Shiraz, Jerry, I know investor feedback is particularly important to you both and to the company, and I will shortly redirect investors to provide you with their thoughts and expectations. But before doing so, I wondered if I may, Shiraz, just ask you for a few closing comments, after which I'll ask investors for their feedback.
Sure, thanks, Mark. So just to sort of summarise, we've really pleased that we've achieved the over the last sort of financial year, we managed to get the business back into profit, back to strong revenue growth. We're not done. Obviously, there's a long way to go, and as Jerry mentioned, we're looking to really build the profits of the business going forward. We believe that there's lots of strong demand for quiz and lots of opportunity going forward. There are headwinds, but we're well positioned, I believe, to deal with those. So we're excited about the future, and we're excited to grow quiz and to continue reporting positive results as we move forward.
That's great. Jerry, Shiraz, thank you once again for your time this morning. Ladies and gentlemen, please can I ask you not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Quiz PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and may I wish you all a very pleasant morning. Thank you.